In 1955, a man in Ohio bought a refrigerator he couldn't afford. He didn't lie to anyone. He didn't rob a bank. He simply signed a piece of paper that let him take the refrigerator home today and pay for it slowly, a little at a time, over the next 2 years. At the time, that felt like magic. No cash up front, no waiting, no saving. Just a signature, and suddenly the future was doing the paying. 70 years later, a 23-year-old in California buys a pair of sneakers using an app that splits the payment into 4 parts. She doesn't call it debt, she calls it pay in 4. Different decade, different device, different marketing language, same exact mistake, hiding in plain sight. Almost nobody sees it happening to them until it has already happened, and by the time they notice, they've usually already convinced themselves it wasn't really a big deal. Every generation believes it's smarter with money than the one before it. Boomers thought their parents were reckless. Millennials thought boomers didn't understand real financial pressure. Gen Z says the same thing about millennials, usually while scrolling past an ad for the exact thing that's about to trap them. And yet, the exact same mistake keeps repeating, decade after decade, wearing a new outfit each time it shows up. It's not overspending. Overspending is just the symptom, the visible part everyone likes to blame. The real mistake is borrowing against a future that hasn't happened yet and assuming your future self will simply handle it when it arrives. That's the whole thing. It sounds almost too simple to explain why so many people stay financially stuck for years, sometimes for decades. But a small mistake, repeated quietly across generations, is exactly how fragile financial habits get built into entire lives, entire households, and eventually entire economies. And this mistake isn't just tolerated by the system around us. It's engineered, refined, and quietly improved every single decade. Picture a bank in the 1950s. A customer wants a refrigerator but doesn't have the cash sitting in their account. The bank doesn't say no. The bank says yes and quietly does something brilliant. It doesn't lend money out of kindness. It lends because the interest paid back over time is worth more than the refrigerator itself will ever be. That's the entire business model of consumer credit, simplified. Sell people access to money they don't currently have and charge them a fee for the privilege of using it early. The credit card, introduced widely across the 1950s and 60s, took this idea and made it invisible. No paperwork for every purchase, no awkward conversation with a loan officer, just a small plastic card that quietly said, "Don't worry about it right now." By the 1980s, department stores had their own versions. By the 2000s, banks had turned it into a trillion-dollar industry built almost entirely on convenience. And today, that same idea has been rebuilt once again. Buy now, pay later apps split a $40 purchase into 4 payments of $10. So small, your brain barely registers it as debt at all. Each version looks newer, faster, and friendlier than the last. Each one removes one more small barrier that used to make people pause. But underneath, it's the same machine. Convert future income into present spending and let the interest, the fees, or the missed payments quietly do the rest. The housing market runs on a version of this same idea, just stretched over 30 years instead of 30 days. A mortgage is, at its core, a promise. Pay a small amount every month for decades, and eventually the house becomes yours. It works beautifully when income rises steadily and interest rates stay reasonable. It becomes dangerous the moment either of those assumptions breaks, which is exactly what happened during the 2008 financial crisis, when millions of borrowers discovered their future income couldn't cover what their past selves had promised.
The system isn't secretly evil, it's just extremely well designed for one side of the transaction. Lenders make money 2 ways: pay on time and they earn interest or transaction fees. Pay late, and they earn even more through penalties. There is almost no version of this story where the lender ends up losing. The borrower's outcome, on the other hand, depends entirely on a level of discipline they may not know they'll need yet, and often don't build until after the damage is done. Credit isn't neutral. It's not a tool that helps everyone equally in every scenario. It performs beautifully for whoever issues it, and only performs well for the person using it if they use it with real precision almost every single time for years. Visa and MasterCard, for example, don't lend you a single dollar. They simply move information between your bank and the store and collect a small fee on every transaction. Multiply that fee by billions of purchases a day, and you understand why these two companies are worth hundreds of billions of dollars without ever risking a cent of their own money on your refrigerator or your sneakers or your rent. The risk sits almost entirely with you. The profit sits almost entirely with them. And the strange part is, both sides usually walk away feeling like they made a reasonable decision. The real damage isn't the debt itself. It's the delay that debt quietly causes. Every dollar spent paying off past purchases is a dollar that didn't get invested, didn't grow, and didn't compound. Compounding is one of those ideas that sounds boring until you actually see it work. Money that grows on top of itself year after year eventually grows faster than the amount you originally put in. Time is the fuel, not the size of the amount you start with, but how early you actually start. So when someone spends 5 years slowly paying off small purchases instead of investing even a little, they're not just losing money. They're losing the version of compounding that only works if you start young enough to let it run for decades. That's the hidden cost of this mistake. It's not the interest on the sneakers. It's the retirement account that never got its 5-year head start. The down payment that took 3 extra years to save. The peace of mind that kept getting pushed further away. Zoom out far enough. And this pattern explains something much bigger than personal finance. It explains why household debt in America has grown for decades, even as wages kept rising. It explains why government debt grows too, in an eerily similar way. Spend now based on future income that hasn't arrived yet, and assume future taxpayers will handle it later. Individuals do it with credit cards, governments do it with bonds. Retirement systems sometimes do it too, promising future payouts based on money that hasn't been earned yet. Even oil markets carry a version of this logic, where future production gets priced into today's contracts long before a single barrel is pumped. The scale is different in every case. The psychology underneath it is identical. Here's the myth. Each generation believes its own version of credit is smarter and safer than the last one. The reality, every version simply made the mistake easier to make, not harder to avoid. Our grandparents needed a signature and a conversation with a loan officer to go into debt. Our parents needed a piece of plastic and a phone call. We just need 4 taps on a screen, sometimes without even opening a second app. The mistake itself didn't get smaller over time. The friction protecting us from it did piece by piece, decade by decade.
And that's really the uncomfortable center of this whole story. People aren't careless with money by nature. The system has spent 70 years quietly removing every pause, every hesitation, every moment where someone might stop and ask, "Do I actually have this?" Each generation simply inherits a slightly smoother version of the same trap, dressed up as progress, marketed as convenience, and rarely questioned until the bill arrives. So the question worth sitting with isn't whether you've made this mistake. Almost everyone has, in some form, at some point, usually without even noticing it at the time. The more useful question is whether you can spot the pattern the next time it shows up wearing a new name. The real question is this: as the friction keeps disappearing and the 4 taps become 2 and the 2 become 1, will anyone still notice they're making the exact same decision their grandparents made back in 1955, standing in a store, staring at a refrigerator they couldn't quite afford yet?